Good morning, everybody. Thank you very much for joining me for this morning's webinar. It's a very beautiful day in Johannesburg today. We've just received our first spring rains, so exceptionally grateful. My name is Denisha Sabji, and I will be talking you through this morning's SURF webinar. On this morning's agenda, we'll take a look at why investing in equities is perfect for a long-term investor. I'll then talk you through the August performance analyses along with the peer relative survey results. And then we'll take a look at some of the key macroeconomic factors that we paid attention to over the month of August. I'll then conclude with our portfolio positioning. As usual, please feel free to write your comments in the chat box, and I'll attend to them at the end of this presentation. So as a member of the Sygnia Umbrella Retirement Fund, you are currently invested in the default life stage model, with the exception of those members that have exercised their member individual choice. Within the default life stage model, the underlying investment philosophy options that are used to underpin the life stage model could be a selection of either the skeleton range, the signature range, or the synergy range. As a reminder, the skeleton range, which is managed predominantly on a passive basis, makes use of underlying investments within specialist index tracking managers, and we at Sygnia manage those managers as well as select them based on their underlying skills, the expertise, and we focus on managers that specialize in index tracking portfolios. Within the signature range, the underlying investments are allocated to a number of specialist asset managers, both active and passive, and we appoint them at Sygnia based once again on their skills, experience, performance, operational and financial soundness. Within the synergy range, we blend an underlying investment allocation to the international building blocks, which makes use of a passive investment philosophy. And then within the local investments, we make use of a number of specialist South African managers, and we use an active mandate for those managers. So for this morning, we will focus on the Signature 70 range, which is the high-risk multi-asset class global balanced product. The aim of the product is to offer investors access to a well-diversified global balanced portfolio, and we utilize the best asset managers in their fields while also ensuring that the risk profile of the strategy remains consistent over time. The Signature 70 fund is suitable for investors that are seeking higher returns and investors that are also willing to tolerate a higher volatility. So ideally suited to investors who aim to maximize their capital accumulation over a long-term time horizon. The recommended investment term for an investor in the Signature 70 fund is at least a minimum of 5 years. Within Signature 70, the product has a medium to high risk profile, and we make use of a 70% strategic asset allocation to domestic and global equities. So that's the largest allocation to the growth products within the Signature range. Within the risk profile of Signature 70, we manage that by spreading out the underlying investments across various different asset classes, as well as among a number of different asset management houses. On slide right now, we are taking a look at the actual asset allocation of the Signature 70 fund over the past 5 years. Local equities to the end of August in this dark green shade right here, represented at 48%. Global equities is the lightest green shade represented on the top of the screen. To the end of August, we have 22% within that strategic asset allocation. Global bonds have a 4% strategic asset allocation. You can see it in the shade I'm pointing out now. However, you can see to the end of August, we have no allocation to global bonds. We continue to avoid an allocation to international bonds because of the artificially financial stimulus, quantitative easing that continues to be used across the globe, as well as the negative interest rates we are currently experiencing. And then within local bonds, we have a 13% strategic asset allocation, and South African income has a 10% strategic asset allocation. Now taking a look at the 15-year scatter plot. So this showing you the performance when we consider the risk return continuum of the various asset classes over the past 15 years. It is very clear that having taken on the additional risk of equities pays off in the long run with greater returns compared to the other asset classes. Local equity performance is represented by the SWIX index, as you can see on the top here, and then just above that is the MSCI World Index converted to rands, which represents international equities. Cash, as measured by the STEFI index, has given us the lowest return for also having taken on the lowest level of risk measured by standard deviation. And then local bonds have delivered the second best return, just behind local and international equities for having taken on a medium risk profile. Currently, within the Sygnia range of portfolios, we continue to avoid an allocation to South African listed property. So over time, we know that different asset classes behave very differently over time, as well as during very different market cycles. Growth assets like equities have consistently shown to outperform inflation, both by exceeding a capital growth objective as well as an income objective. And we all know that in order to invest well, we need to outperform inflation. It is one of the key successes to long-term investment disciplines. It means that all of your hard-earned savings continue to stay ahead of CPI, and it also means that your long-term purchasing power parity of your savings is maintained. Growth assets aim to steer clear of inflation as best they can, but this also implies that investors must continue to expect volatility and a wider dispersion of returns when investing in them. So there's a short-term cost that investors have to pay for the longer-term inflation-beating returns. If we consider defensive asset classes such as cash and bonds, they aim to receive more stable returns relative to growth assets. However, those asset classes offer very little protection against rand erosion and the qualities of inflation. Considering the 15-year cumulative returns that we are looking at on screen now of the various asset classes, you can see in the two lightest green shades that I am pointing out, that representing the JSE SWIX index, indicative of South African equity performance, as well as the MSCI World Index converted to rands, representing international equity performance, having delivered the highest performance compared to the other asset classes, property, bonds, and cash. So this pins down the investment theory that for investors that have a long-term investment horizon, it is best to invest in equities. Over the various market cycles, equities do tend to give us the best performance, having outperformed inflation, having outperformed a strategic benchmark, as well as a CPI objective. Let's now step onto the market and performance analysis. We are paying attention to the numbers to the end of August. So taking a look at the JSE SWIX index to the end of 1 year, you can see a 22.6% return. A reminder that within the Sygnia range of portfolios, as well as the skeleton range of portfolios, we make use of the SWIX index as our equity benchmark. A lot of this recovery having been driven by financials to the end of August, having delivered 52.2%. Resources have started to come down from that high base we saw in the start of this year at 90%. To the end of August, resources delivered 25.3%. We continue to remain underweight South African equity because within our Sygnia portfolios, we currently do not anticipate to see such strong double-digit returns coming through from the domestic equity market for the remainder of this year. If we then take a look at South African listed property over 1 year, a stellar performer, 51%. However, over 3 years and 5 years, you can see that property within the South African space still continues to struggle with negative returns. A reminder that we continue to avoid allocations to South African listed property within the Sygnia and the skeleton range of portfolios. Then considering bonds, this is the JSE All Bond Composite Index to the end of 1 year, 14.8%. It is the second highest asset class performance, just after equities, and then STEFI index, representative of cash to the end of 1 year, 3.8%. So as you can see, the growth allocations, being equities, have outperformed those defensive asset allocations of cash and bonds to the end of 1 year. In terms of Regulation 28 of the Pension Funds Act, we can take 25% of retirement fund investing to international markets. We are investing across various asset classes, and to the end of August, developed market equities, as measured by the MSCI World Index converted to South African rands, has delivered 10.8%. Just below that, emerging markets, having struggled to the end of August, only having delivered 3.4%. A lot of this is coming through because of the short-term volatility experienced, especially within China, as we saw regulations being amended within the education sector and within the gaming and social media sectors. Just below that, the MSCI All Country World Index, representative of equities in other markets, 9.8%, and then international properties having delivered 14.9%. Within our portfolios, we do have an allocation to international properties, but we are focused on the specialist real estate sector, and a strong performance coming through there with 14.9%. And then just below that, the Barclays Capital Gold Global Bond Index, negative 14.2%. Unfortunately, international bonds continue to struggle because of the quantitative easing across the developed world, as well as the negative and the muted interest rates we are experiencing. So within our portfolios, we continue to avoid an allocation to global bonds. You can see to the 3-month period a slight recovery of 5.5%, however quite short-lived. To the month end August, even year to date, still negative returns coming through for international bonds. And then considering our rand against the US dollar, the rand continued to be one of the best emerging market currencies throughout this year. As you can see, to the end of 1 year, the US dollar has depreciated 14.6% against our currency, and we do expect to see additional volatility coming through for the rest of the year. Therefore, we do use a hedge fund protection of our currency. Today, we see the rand trading at around 15 rand 10 cents, just talking to the fears of inflation rising and perhaps the South African Reserve Bank deciding on an interest rate increase before the end of this year. We'll have to wait and see how that plays out. Let's now step on to the investment performance to the end of August, paying attention to those 1-year numbers. Signature 70 delivered 18.7%, and then Skeleton 70 having delivered 16.8%, Synergy 70 having delivered 21.5%, each of the SURF ranges ahead of our strategic benchmark to the end of August. And then the same is true for the Signature, Skeleton, and Synergy 60 funds, also ahead of the benchmark of 13.1%. You can see Signature 60 at 17.1%, Skeleton 60 at 15.4%, and Synergy 60 at 18.8%. Then looking at the more medium and conservative funds, the 50 and the 40 ranges, once again ahead of that strategic benchmark to the end of August. Very interesting to see that the active managers are starting to have an additional performance based on the fact that within the Synergy range, the active managers are holding an allocation to South African listed property. We saw a short-term recovery coming through to the end of August, a whopping 51% within that sector. And then also the active managers making use of the capped SWIX as a benchmark for equity, very different to our Skeleton and our Synergy range, where we are tracking the SWIX index. Over and above that, our portfolios are also ahead of the CPI benchmark. So let's consider those long-term numbers. You are aware of the fact that within the SURF range, we have a secondary objective where we benchmark ourselves against that CPI target, and talking to those introductory slides that I showed you with regards to equities being the place for long-term investors, you can see within the signature and the skeleton range, over 10 years, we've been able to outperform that CPI plus 7% target. Within the signature and skeleton 60 range, we are also outperforming the CPI plus 5% target. And then the same is true for signature 50 and signature 40, where we are able to outperform both that CPI plus 5% and CPI plus 3% targets respectively. The synergy range does not yet have a 10-year track record, and that's why we aren't showing a number within those particular ranges. And then, of course, over the shorter term period, over 1 year and 2 years, each of the ranges have also been able to outperform the respective CPI targets. Over the shorter term, 6 months, it is only skeleton 70 and skeleton 50, which has slightly lagged that CPI plus 7% target and the CPI plus 5% target, respectively. However, that is a short-term indication of the portfolio's performance, and the portfolios have been able to respectively correct themselves and outperform that CPI target to the end of 1 year, 2 years, and even longer term, 10 years. Now looking at the peer relative survey results to the end of August, starting with the low equity range of the survey. You are familiar with the Alexander Forbes Global Large Manager Watch survey. Our Sygnia funds qualify for the survey purely based on investment performance, and we are also taking a look at various different investment philosophies. So a reminder that Signature blends active and passive investment mandates, whereas the Synergy range uses an active balanced mandate for the local equity managers, and then our skeleton range is purely passively managed. As you can see, over 1 year within low equity, Signature 40, Synergy 40, and Skeleton 40, all delivering strong double-digit returns. And then over 2 years, as well as 3 years, we continue to maintain the first and second place, the first and third place. And then over 5 years, 7 and 10 years, our funds are coming closer to the top. Also note that to the 10-year period, we have fewer peers to compare ourselves against because of the fact that not all peers have such a long-term track record. Now looking at the low medium equity range of the survey, this is where the Synergy 50, Signature 50, and Skeleton 50 funds feature. Strong double-digit returns coming through to the end of August, and then over the 1 year period, August, over 2 years and 3 years, still outperforming most peers. Over 5 years, 7 and 10 years, once again maintaining those first, third, and second place positions. Considering the medium equity range of the survey, this is for the 60 range of portfolios. You can see that over 1 year, Synergy 60 has that 18.8% return, Signature 60 at 17.1%, and Skeleton 60 at 15.4%. Over 2 years, our fund within this particular range of the survey has been able to maintain the second, third, and fourth place. And over 3 years, Signature 60 is in first place with Skeleton 60 in third place and Synergy 60 in fourth place. And then over 5, 7, and 10 years, our funds have been able to be the top performers. A reminder that Synergy does not have a 10-year track record. And then considering the high equity range of the survey, so this is where the 70 funds feature, Synergy 70 at 21.5%, Signature 70 at 18.7%, and then Skeleton 70 at 16.8%. Over 2 years and 3 years, our funds consistently are able to outperform some of the peers. And then if we look at that longer term track record, 7 and 10 years, once again, Synergy and Signature at the top, and over 10 years, Signature and Skeleton outperforming most peers. Just a reminder, in terms of those 1 year numbers, we are seeing that over the shorter term, some of the managers have enjoyed that short-term recovery within the property sector, and the fact that other managers, especially the active managers, are benchmarked against the CAP SWIX, which did better to the month end of August compared to the SWIX index, which we use within our range of portfolios. So that talking to the different performance returns of that 12-month period. And then considering our funds against the performance of the single managers, and of course, a reminder that our funds are multi-managed, but it's nice to see how we fared against some of the bigger house names. So to the end of 1 year, Synergy 70 at 21.5%, with Signature 70 at 18.7%, and Skeleton 70 at 16.8%. We've got Old Mutual, Coronation, and Prudential having performed in the top 3 places. Over 2 years, Signature 70 is right behind Coronation, and then over 3 years, our Signature 70 and Synergy 70 funds have maintained the second and third place, with Skeleton 70, even though it is a passively managed fund, having outperformed a lot of those other single managers to the end of 3 years. And then over 5 years, 7 and 10 years, once again, you can see Synergy 70 tying with Coronation. And then we've got Synergy 70 and Signature 70 over 7 years in second and third place. And then over 10 years, our Signature 70 fund is the best performer, with Skeleton 70 having delivered 12.3%. So as you can see, the Sygnia portfolios continue to harness the volatility, and we continue to navigate through the various different market cycles, ensuring that our members are able to receive the highest possible returns for an adequate level of risk compared to peers in the industry. So this graph ties it up quite nicely. It is our risk return scatter plot, and it is showing us risk return over the past 7 years to the end of August. In terms of investment philosophy, all of our Signature range of portfolios, including the Skeleton and the Synergy range of portfolios, currently fall within the efficient frontier. So we are quite happy that each of our portfolios continue to deliver the optimal level of return for the risk assumed. Just out of interest, looking at the 70 range of funds, you can see that some of the managers below us have taken on a similar risk profile in terms of standard deviation. However, their performance is lower compared to that of Synergy 70 and Signature 70. We'll now step on to the key macro and economic themes that we paid attention to for the month of August, in order to give you some context with regards to why we position our portfolios the way that we do, as well as for you to understand where we perceive risks to be into the rest of this year. So on screen right now, we have Dr. Anthony Stephen Fauci. He is the director of the US National Institute of Allergy and Infectious Diseases. He is also the chief medical advisor to the US president. He has called the Delta variant the greatest threat to eliminating the coronavirus. So during the month of August, we've seen that the Delta variant has continued to wreak havoc, with the COVID cases increasing significantly in the United States. During August, the US had nearly 38 million confirmed new daily COVID cases, and unfortunately more than 628,000 new deaths. So the Delta variant has also breached New Zealand, which was previously COVID-free, and it's actually pushed the number of COVID cases to more than 100 within 7 days, causing New Zealand to go into a lockdown for the first time, which was initially for 3 days and then further extended to the end of August. However, despite the increase in the number of new daily cases because of the Delta variant, as depicted in this light red line here, you can see that the Google Activity Index continues to increase. So what we saw within South Africa is that initially the vaccination take-up seemed to have stalled somewhat, but as soon as the rollout was extended to adults over 18 years old, we saw our vaccination numbers surpassing 12 million during that month of August. Going forward, we do believe that despite the Delta variant, global mobility will continue to increase, because we see that vaccines are assisting developed countries to better handle lockdowns. We've also seen that governments are better able to restrict the movement of people. And as populations, we have become more comfortable with regards to living with COVID. Currently, within our Sygnia portfolios, we do believe that growth will start to recover as more vaccines are rolled out across the world. And therefore, we do remain overweight our value theme and underweight global bonds, actually no allocation to international bonds. We continue to avoid an allocation to gold. Not only do the prices of gold as well as international bonds remain distorted because of quantitative easing, but we do think that as growth recovers around the world, that it will not be good for those previously safe haven type assets. And then focusing on the different regions, taking a look at the USA, two landmark events that happened in August. These past two presidents have made history. We have Richard Nixon, who is here because 50 years ago in 1971 at around $35 an ounce, he ended the USA's gold standard, where the US would previously accept dollars and then exchange it for gold bars. And then I've mentioned that we actually hold no allocation to gold because of the distortion within that particular safe haven type asset. And then we also have George W. Bush, who had initially launched the war on terror in Afghanistan almost 20 years ago. During the month of August, we saw President Joe Biden, the current US president, ending that war. He's removed the US troops from the Middle East, and it forms part of the Biden administration's strategic focus to start paying attention to what they perceive to be the biggest threats over the next decade. That will certainly be China as well as Russia, both from a technology perspective as well as a monetary perspective. Within the USA, we currently remain underweight an allocation to equity. It is our largest funding position, and we do use it for the other regions as well as our other thematic satellites. One of the reasons for this is valuation. So if we look at this chart on the right, it is showing us the bottom-up analyst expectations for the S&P 500 margins. You can see the dotted line is the forecast, so expecting margins to increase from nearly 12% to just over 13%. However, given the current uncertainties in the US market, we don't believe that such a rapid increase in margins is likely, and we do anticipate disappointing earnings going forward that will definitely lead to disappointing share prices. The other reason we continue to remain underweight US equity is because of the large weight of the technology sector stocks in the US market. Over the past decade, we have seen that the US has been the stellar performer, which was driven predominantly by large cap technology stocks. Going forward, we believe that some of the headwinds to risk that we expect are accelerated antitrust legislation, as well as the potential harm that social media is doing. So very interesting research that has come out indicating that there is currently a very strong correlation between US population depression rates and the use of social media. We believe that going forward, social media firms could actually be the equivalent of the cigarette companies of the 80s and start facing heavy regulations over the next decade. So during the month of August, we actually rotated more of our US exposure out of the S&P 500 into the US value ETF, which currently has a higher weight to banks and industrial type stocks. We like industrials because of the fact that they are very correlated to the US infrastructure package that has recently been approved by President Joe Biden. And we also like banks because we believe that they will do well as the yield curve steepens and interest rates start to rise as growth around the world starts to recover. Then taking a look at China, so even though it is referred to as an emerging market economy, it is currently the second largest economy in the world. During the month of August, their president Xi Jinping has announced a plan for common prosperity within China. They are aiming to grow the size and the well-being of the middle class population by the year 2048. So this is certainly why we believe China is a great investment opportunity over the next decade. The original thesis, which remains, is that Asia will continue to see the largest increase in the global share of the middle class of the population, which will be excellent for the economy. It is currently where all of the major spending lies. Over the next 10 years, Asia's middle class population is expected to grow from around 54% to about 65%. So as the middle class population move up the living standard curve, they are likely to spend more money, and that will drive up domestic growth. During the month of August, we saw China's State Council and Communist Party's Central Committee calling for greater regulation of an economy. And of course, you know that no markets like changing regulation, so it was definitely a concern. It's one of the reasons why we saw a short-term contraction in terms of equity market performance within emerging markets over the month of July as well as August. We also saw tougher rules coming through for how companies handle user data, and Chinese regulators have started to tighten the online gaming rules for teenagers, now limiting the time that they spend on internet gaming to only 3 hours a week. What was so ironic is that as soon as that announcement was made, we saw Nasdaq's 10-cent in process bouncing back almost 12%, so almost as though markets were expecting a little more stricter in terms of regulation. We do believe going forward that China cannot afford to self-inflict an economic collapse, and there's a lot of debt currently within the economy. They remain concerned about unemployment, and they are very focused on shifting to their new economy sectors. So away from manufacturing type sectors into research and development, technology, education, social media, health and innovation. So we do believe that even though we saw a slowdown in the economy over the month of July and over the month of August, that we will start seeing their government supporting them. We're likely to see additional support in the short term to avoid a hard slowdown. And that's why we remain comfortable being overweight emerging markets and holding small Chinese technology type exposure. The chart on the right shows China's equity underperformance relative to the emerging markets investable indices, actually representing the impact of tech relative to their risk. We also saw in the month of August that the China All System Financing Aggregate, which represents how much money is being borrowed, fell by close to 71%, reflecting the new COVID restrictions that were introduced, as well as severe flooding and global supply disruptions. But we do believe that this was short-lived, and we will see a correction in this particular emerging market over the next while. We continue to be overweight our emerging market allocation because we believe that over the next decade, the middle class population will continue to drive up domestic growth. And then coming closer to home, South Africa continues to be a mixed bag. As we correctly predicted within local equities, despite their very strong run for the first 2 quarters of this year, we did see during the month of July and August that resources would start to taper off, as well as industrials and consumer type sectors. We do expect that for the rest of this year, additional volatility coming through from the local market. Currently within our portfolio, Sygnia tries and makes the most of that volatility, and we continue to harness it by making use of the tactical asset allocation. During August, the major news was the reshuffle of the cabinet. We saw President Ramaphosa abolishing the security ministry and placing the political responsibility for the spy agency within his office. So certainly on the face of the change, it would have been a cause of concern, but given what happened in July with the civil unrest, the looting and the violence experienced in Gauteng and KZN, the change was well received by markets. However, what wasn't very well received and caught both South African investors as well as international investors by surprise was the exit of our finance minister, Tito Mboweni. He has always been seen as a strong pro-reform driver and has done a great job as the finance minister for the short time that he was in cabinet. So the key focus for the rest of this year will be on the budget speech in February, as well as to see what his replacement, Enoch Gondangwa, and the new policies he will put in place. In August, we also saw South Africa's unemployment rate rising to 34.4%, currently the highest rate in the world. For growth to recover in SA, we know that we need labor supply and we need productivity over the longer term. If we take a look at this chart here on the right, it's showing us the GDP per hour worked, representing a measure of productivity. And then at the bottom, the quality of the education system. This is sourced from Colchester and it is from the World Bank. Unfortunately for us, South Africa is this tiny circle right at the bottom here, indicating that we currently have the worst education system in the world, which then equates to the lowest productivity as well as the lowest ability to grow out of debt. This means that going forward, it is one of South Africa's biggest hurdles over the medium and the long term. It will remain incredibly difficult for us to grow out of debt, to create jobs, and to encourage investment, especially foreign direct investment into our country. Within our portfolios, we remain underweight South African equity until such time that we start seeing reforms being executed. It's very difficult for us to continue to invest within the strategic asset allocation for South African equity. Then stepping onto the positioning. So in order for us to ensure that our members continue to receive the best possible returns over the long term, we have positioned our portfolios to continue investing in a low growth environment. At the core of our investment philosophy, we are underweight South African equities for the reasons I've just explained. We currently have an overweight position to South African bonds. We currently have no allocation to international bonds because of quantitative easing and negative interest rates. And then our largest overweight position is within global equity. Within the international satellites, we make use of various different themes, which we believe will continue to enhance the portfolio performance for our members over the shorter term, as well as over the longer term. We remain overweight our MSCI as we continue to balance the growth bias in the cyclical recovery across the world. We do believe that as people learn to better live with COVID-19 and more vaccines are rolled out across the world, growth around the world will continue to recover, and that's why we use a value tilt out that growth bias. The next theme is bond alternatives. Currently, in the month of August, we have halved our exposure to the Sygnia ITRIX property ETF in favor of our emerging markets theme. This sector of real estate focuses on specialist industrial type sectors such as cell phone towers, data storage facilities, as well as hospitals. We continue to avoid an allocation to leisure resorts, hotels, and the retail property sector. The next theme that we focus on is disruptive technologies. This represents our allocation to the Fourth Industrial Revolution Fund. The Fourth Industrial Revolution Fund is focused on futuristic trends and tracks the Disruptive Innovation Index. It represents new products that will continue to steal market share from existing products, even as the world slows down in terms of a revenue environment. The fund has well over 380 different constituents, which span across various different regions, various different sectors. So we're looking at things like 3D printing, nanotechnology, biotechnology, virtual reality, space exploration, drones, artificial intelligence. It's absolutely fascinating. Everything focused on the fourth industrial revolution. It's one of our funds that continue to be a stellar performer on the international front and continue to enhance alpha for our members. The next theme is that of emerging markets within Asia, so the likes of China, some allocation to India and Brazil. And the original thesis, which remains, is that Asia will continue to see the largest increase in the global share of the middle class population over the next decade. It's very exciting that as a middle class population increases, they continue to spend more within the economy, and that will drive up domestic growth. Excuse me. We continue to remain excited about emerging markets, and we have used an opportunity in August to buy a further allocation within that particular theme. And then the last thematic satellite that you can see on screen is health innovations. We do believe that healthcare benefits from aging populations around the world, particularly within developed markets such as Japan, Europe, China, to some extent also the US. And we expect to see increased spending on healthcare that will be partly driven by new technologies, new developments in products, new medical procedures, as well as new vaccines that will be rolled out. As a human population, we will continue to push the boundaries on the medical frontier and do whatever we can in order to slow down the aging process, as well as to improve the living standards of people. Very interesting to see that most governments across the world, since the outbreak of the COVID-19 pandemic, has started to allocate more funding in terms of their annual budget towards research and development within the healthcare sector. Going forward, we do believe that research for new medical enhancements and products will continue to allow for new entrants into the markets, which will ultimately benefit patients as well as pharmaceutical companies' profit and their revenue stream into the future. So this thematic satellite includes our allocation to the Oxford Sciences and Innovation Fund, as well as our Healthcare Equity Fund, which invests in some of the world's most successful medical sector companies in the developed markets. We also make sure that we allow for diversification in terms of currencies. So the OSI fund is currently denominated in the British pound. Over and above that, we do make use of the US dollar, and we are using a hedge protection in terms of volatility of the rand. That brings me to the end of this morning's presentation. Let me take a look to see if there are any questions. So just a question on what's happened to the rand. We have seen some depreciation of the rand over the short term. This morning, when I checked, it was at around 15 rand 10 cents to the US dollar. And this is just based on our short-term fears with regards to inflation pressures coming through within South Africa, as well as anticipation that perhaps we may see an interest rate increase from the South African Reserve Bank before the end of the year. A reminder that the South African Reserve Bank does target a 3 to 6% inflation band. So because we are currently on the lower end, it may give an indicative stance that interest rate hikes are likely to happen. However, we will have to wait and see what happens in the last MPC meeting. There are no other questions that I see. I thank everyone for joining me this morning. We do appreciate your time. Please continue to stay safe and have a wonderful day going further. Thank you. Goodbye.